What should long-term investors do when the future expected rate of return in the US markets doesn't look good? In last week's video, we discussed Goldman Sachs' recent report projecting a 3% rate of return in the S&P 500 over the next 10 years. Now, as stock market investors, we are probably expecting more than this in our portfolio, in our financial plan. And so what are we supposed to do if the next 10 years, the S&P 500 only gets a few percent rate of return? And in today's video, we're going to spend a few minutes talking about where you can invest other than the S&P 500. This is not a recommendation, but we are going to go through some numbers that you should think about when you're looking at your portfolio and you're thinking about diversification. And so in particular, in today, we're going to talk about international investing. Now, what does that mean? It just means investing not in the United States. As investors, over the last 10 or 15 years, some of us have actually forgotten that international investing might be a reasonable idea because the S&P 500 has done so well. And if you were to not internationally invest over the last 10 or 15 years, you did pretty good. And many times we look at the last short period of time, in this case 10 years or so, while it feels like a long period of time, in terms of long-term investing, it's not. But we look at that and we say, hey, look, my strategy has been successful. I've just been investing in the S&P 500. I will just keep doing that, which you absolutely can. Keep in mind, as one index gets more expensive, in this case the S&P 500 has gotten more expensive, you're going to see these longer term expected rates of return, like just came out with Goldman Sachs, projecting a lower rate of return. Because you've had a abnormally high rate of return for a longer period of time, now you would expect an abnormally low rate of return to balance it out, to give back to the averages. And so if you were to believe that, you say, okay, what do I do now? And in per day, like I said, we're going to talk about international markets. We're going to talk about a specific chart comparing how do international markets compare to US markets over the last 70 or so years. Okay, let's jump in. This chart here goes back to 1974, and it essentially looks and says, okay, when the bars are above the line, that means international is outperforming. When the bars are below the line, that means the US is outperforming. And so let's fill in these lines. The light gray up at the top, those are periods where international is outperforming. Those dark gray or black bars are the US outperforming. Now, what you might see, if you're just looking at it intuitively and at a glance, you'd say, well, sometimes one is outperforming, sometimes the other. It kind of goes back and forth. And if you were to take that and look towards the end, where you see this is 175 months. So going back to 2009 to today, the US or the S&P 500 has been outperforming international markets. And there's two trains of thought where your mind might go next. One is, well, this time it's different. It's not going to go back and forth anymore. The US is going to outperform forever, game over, invest in the US only. That could be the way that you look at it. Another way to look at this might say, well, it looks like the international goes and wins sometimes, and then the US wins sometimes, which makes sense. Certain markets get more expensive, they get overheated, then they come back, and then one will get overheated, and they just take turns over time. If you were to believe that, you might look at this and say, wow, I'm not sure how much longer this can continue where the US outperforms international, and when it does switch back, it could switch back in a big way. Now, whether you think this time it's different, international is going to outperform, or US is going to outperform forever, or you think it's going to continue to go back and forth, these are important numbers to know that when you are looking globally, the US does not always outperform. It's far from it. On average, the returns between international and the returns between US are very similar rates of return. They just happen at different times. One does better, one does worse, and then they just flip-flop. Ultimately, can lead to a great conversation about maybe we shouldn't need to guess. Maybe we should just make sure that we are fully diversified as long-term investors. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.